Welcome to this explainer. Today we're going to completely skip past all those noisy, endless online debates about artificial intelligence. Right now, it feels like half the internet is screaming that AI is the biggest bubble in history, while the other half insists it's the greatest breakthrough since sliced bread. But you know what the uncomfortable truth is? They're both arguing about the wrong thing entirely. So today, we're going to dig into the hidden structural reality of how the money is actually moving.
Everyone's hyper-focused on demand right now, right? They're looking at user growth, adoption rates, and all these shifting narratives. But if we really want to find the truth, we need to flip that coin and look at supply. Why? Well, because while demand can be faked or manufactured or just propped up by a really good story, upfront capital cannot. Supply takes real, hard cash committed upfront, and that tells the true story of what's actually unfolding in the economy.
All right, let's jump right into Section 1, the distraction. Take a look at the sheer, terrifying scale of the money pouring into the supply side of the AI industry right now, because frankly, it's unlike anything we have ever seen. I mean, just look at this number. This year alone, the biggest tech companies in the world are projected to spend $725 billion on artificial intelligence. That isn't just a big number, it's an almost incomprehensible amount of capital being unleashed into a single sector in just a single year.
To really put that $725 billion into perspective, try this quick thought experiment. Imagine spending $1 million every single day. Start on the day Jesus was born. Keep going through the Roman Empire, the Middle Ages, both world wars, literally right up to today. And you know what? You still wouldn't hit what big tech is spending on AI this year alone. That is the sheer mind-blowing magnitude of this supply buildout. Breaking it down even more, that equals roughly $2 billion a day, or 83 million an hour, 23 grand every single second. Honestly, by the time you finish watching this explainer, millions more will have been spent. So this massive flood of cash naturally raises the absolute most crucial question: are we in the middle of a massive, unprecedented financial bubble?
Well, the answer doesn't actually depend on whether AI technology is good or bad. In fact, if you look at a historical study of 175 years of major tech breakthroughs, it turns out that 37 out of 51 of those innovations triggered a massive speculative bubble. Billionaire investor George Soros really hit the nail on the head here. He noted that bubbles are always rooted in a solid basis of reality, but that reality just gets wildly distorted by misconception.
Which brings us to Section 2, the blueprint. So, to predict what happens next with AI, we don't need to invent some brand new economic theory. We actually just need to dust off an old framework from Adam Smith, dating all the way back to the 1700s. Smith noticed that money just naturally chases high returns. When an industry looks incredibly profitable, cash rushes in. But, and here's the catch, that capital brings intense competition, and that competition ends up crushing the exact returns that attracted it in the first place. Today we call this the capital cycle theory. It completely ignores all the noise of demand and strictly follows the supply.
Now, this theory tracks a really predictable four-step cycle. Step 1 is the flood. New tech arrives and the money just pours in. Step 2 is the boom. Capital keeps flowing, competitors pile in way faster than demand can actually grow, and returns start to slip. Step 3 is the collapse. All that brand new supply absolutely crushes prices and companies start to fail. And finally, step 4 is the inheritance. Capital flees the wreckage, the original builders go bankrupt, and a totally new generation walks in to buy those highly valuable assets for pennies on the dollar. Of course, you'll always hear intoxicated investors claim that, well, the old rules simply don't apply to this shiny new technology. But as billionaire investor Howard Marks loves to warn, the 4 worst words in the financial world are, "It's different this time." Because trust me, history absolutely loves to repeat itself. Let's look at Section 3, when history rhymes. Let's actually trace this exact 4-step cycle across 3 totally different centuries and technologies. We've got the British Railways in the 1830s, the fiber optic cables during the late 90s dot-com boom, and shale oil fracking in the 2010s. 3 completely different industries, right? But the underlying pattern playing out underneath all of them was flawlessly exactly identical. The really crucial point here is how they all ended. In every single era, the initial builders completely flooded the market with supply. The railway index lost half its value by 1850. During the telecom bust, 85% of fiber just sat totally unused, and bandwidth prices plummeted 90%. And when fracking blew past demand, oil dropped from $100 a barrel down to 30, triggering over 200 bankruptcies. The original builders bankrupted themselves laying the groundwork.
But, and don't miss this, they left incredibly valuable, world-changing infrastructure in the ground for the next generation to scoop up at a massive discount.
Moving on to Section 4, the AI illusion.
Now let's turn this analytical X-ray vision onto the current artificial intelligence industry. Because right now, AI is basically holding up our entire economy. Harvard economist Jason Furman revealed a staggering fragility here. Looking at early 2025, AI investment accounted for only about 4% of GDP. But astonishingly, that tiny 4% accounted for roughly 92% of all U.S. economic growth. Literally, if you strip the AI build-out away, the U.S. economy barely grew at all. We are completely dependent on this one massive bet.
And remember earlier how we said demand can be faked? Well, in the fiber boom, telecom companies literally loaned their own customers money to buy their gear. And AI is kind of running the exact same playbook. Massive tech companies are creating this circular loop of money. NVIDIA funds OpenAI, OpenAI takes that money and pays Oracle for computing power, and Oracle takes that revenue to buy more chips from NVIDIA. The money just goes round and round in a circle, getting counted as brand new end demand every single time it changes hands, artificially propping up those revenue numbers.
But you just can't escape the gravity of the capital cycle forever. Despite all the endless hype and those circular money loops, reality is starting to bite. When OpenAI's financials leaked, they revealed a massive loss of $38.5 billion in 2025 alone. Just think about that for a second. That is nearly 8 times their loss from the year before. Fierce competition from Google, Anthropic, Meta, and others have flooded the market, and returns are officially getting compressed.
And buried deep inside those financials is the real red flag. OpenAI spent $5.7 billion, which is an astonishing 44% of their entire revenue, just on sales and marketing. They're literally bleeding cash just to keep people using their product as the hype fades and the returns start to slip. Guys, this is exactly what the boom phase looks like right before the collapse.
Right now, the broader market is priced for absolute mathematical perfection. We saw a really clear warning sign of this when chipmaker Broadcom guided their future sales just slightly soft. Instantly, $300 billion in market value vanished in a single day. When a rounding error erases $250 billion, you are not looking at a healthy market. You are looking at a market teetering right on the edge of the supply cliff.
Finally, let's wrap up with Section 5, the aftermath.
This brings us to the inevitable conclusion of the capital cycle, and really the ultimate lesson for this current AI era. It brilliantly illustrates this old, ruthless rule in business. The pioneers take the arrows, and the settlers get the land. The pioneers are the first movers who flood in, spend all the massive capital, build the risky infrastructure, and basically absorb all the resistance and losses. The settlers? They're the ones who just walk in later, after the dust is settled and the bankruptcies are filed, to quietly inherit all those highly valuable assets without ever taking a single arrow.
We have watched this happen time and time again. In early internet search, pioneers like AltaVista and Lycos spent millions teaching the world what a search engine even was, ultimately bleeding cash and letting their products decay. Then Google walked in as the settler and took the whole shebang. In rideshare, a company called Sidecar fought the brutal early legal battles against taxi commissions and literally bled out in court. Uber and Lyft just walked right onto the foundation Sidecar built and took over the world. The original builders pay the price. The second movers inherit the future.
So as you watch the daily headlines scream about artificial intelligence, remember to just ignore the noise on the demand side. Look at the quiet, ruthless mechanics of the supply side. Asking if AI is a bubble or not is entirely the wrong question. The real question you should be asking yourself is this: in this massive $725 billion build-out, who is about to drown in the flood of their own supply, and who is waiting quietly in the wings to inherit the future?